Let's be real for a second. Money can feel incredibly overwhelming. It's like everyone else got a secret user manual at birth, and you were left trying to figure it all out on your own. We're taught algebra and history in school, but when it comes to managing our own finances, we're often left in the dark. This confusion isn't your fault. Financial topics are often wrapped in complicated jargon and confusing charts, making it seem like you need a special degree just to understand how to save for the future. It's designed to feel intimidating, but I'm here to tell you that it doesn't have to be. The truth is, building wealth often comes down to understanding just a few key principles. The single most powerful concept in all of personal finance is something called compound interest. I know the word interest might already make you want to close this page, but stick with me. This isn't some complex Wall Street strategy. It's a simple, powerful force that can either work for you or against you every single day. Albert Einstein reportedly called it the eighth wonder of the world, and for good reason. Understanding this one idea can literally change your financial future, turning small, consistent efforts into significant wealth over time. It's the closest thing we have to a real-life money hack, and it's available to everyone, not just the rich. Think of it like this. Mastering your money isn't about making one brilliant move that makes you rich overnight. It's not about timing the market perfectly or finding some secret stock pick. Instead, it's about setting up a system that works for you, quietly and consistently, in the background of your life. It's about making your money work for you, instead of you always having to work for your money. Once you grasp the simple magic of compounding, you'll see your savings and investments in a whole new light. You'll stop seeing them as just money sitting in an account and start seeing them as an army of tiny workers, all generating more workers for you. So, let's break this down together, step by step, with no confusing terms. We're going to demystify compound interest and show you exactly how it works with real numbers and clear examples. By the end of this, you'll not only understand what it is, but you'll have a clear plan for how to use it to your advantage. This isn't just theory. This is the practical knowledge that separates people who build wealth from those who struggle to get by. It's the secret money lesson you should have learned in school, and it's time you finally got the inside scoop. Let's get into it. To really understand why compound interest is so powerful, we first need to look at its much less exciting cousin, simple interest. Imagine you lend a friend $1,000, and you agree on a simple interest rate of 10% per year. This means that every year you will earn 10% of your original $1,000. So, after the first year, you earn $100. After the second year, you earn another $100. After 10 years, you've earned a total of $1,000 in interest, $100 per year for 10 years. It's straightforward, it's predictable, and it's a little slow. Your earnings are always based on that initial amount you started with. Now let's switch gears to compound interest. Let's use that same $1,000 at a 10% annual interest rate, but this time it's compounding. In the first year, just like with simple interest, you earn $100. No difference yet. But here is where the magic happens. In the second year, you don't just earn interest on your original $1,000. You earn interest on your new total, which is $1,100. So 10% of $1,100 is $110. In year 2, you made an extra $10, not from doing anything different, but simply because your interest started earning its own interest. This might not sound like a huge deal, but this is the start of a powerful chain reaction. The best way to visualize this is the snowball analogy. Simple interest is like making a new small snowball every single day and adding it to a pile. Your pile grows, but it grows at a steady, linear pace. Compound interest, on the other hand, is like starting with one small snowball at the top of a very long, snowy hill. As you roll it down, it picks up more snow, getting bigger and bigger. The bigger the snowball gets, the more snow it picks up with each rotation. Before you know it, that tiny snowball has become a giant, unstoppable boulder, all thanks to momentum. This is exactly how compound interest works with your money. Your initial investment is the small snowball. The interest it earns is the new snow it picks up. As that new snow becomes part of the snowball, it helps pick up even more snow on the next turn. In the third year of our example, you'd be earning 10% on $1,210. which comes out to $121. Your earnings are accelerating. This acceleration is the fundamental secret to building wealth over the long term, turning a little bit of money into a whole lot more. Let's put some real numbers to this to see just how dramatic the difference becomes over time. We'll use our $1,000 investment at 10% annual rate. Let's fast forward and see what happens after 20 years. With simple interest, the calculation is easy. You earn $100 every year for 20 years. That's $2,000 in interest. Add that to your original $1,000 and you have $3,000 total. Not bad, you tripled your money. But hold on, because compound interest is about to blow that out of the water. With compound interest, that growth gets faster and faster. In year 10, your balance would be about $2,594. By year 20, that same $1,000 has exploded to $6,727. Let that sink in for a moment. That's more than double what you'd have with simple interest. The only difference was how the interest was calculated. You didn't have to invest more money or find a riskier investment. You just let the power of compounding do its thing. The interest you earned in early years became the workhorse that generated even bigger returns later on. The visual difference is stunning. If you plot this on a graph, the simple interest line is straight and predictable, chugging along at constant speed. The compound interest line starts off almost identical, but then begins to curve upwards, slowly at first, then more and more steeply until it's shooting for the sky. This upward curve is where fortunes are made. It represents your money earning money on itself, creating almost unstoppable growth over time. This isn't just hypothetical. This is how real-world investing works in things like 401(k)s or S&P 500 index funds. When you reinvest dividends or capital gains, you're letting your money compound. You're taking the snow your investment picked up and rolling it back into the snowball, making it bigger for the next turn. This is why long-term investing is so powerful. You're not just relying on your contributions, you're building a self-sustaining growth engine that works for you 24/7, even while you sleep. Now that you see how powerful compounding is, let's talk about the single most important ingredient in this recipe for wealth time. The more time your money has to compound, the more dramatic the results will be. To illustrate this, let's imagine two friends, Amy and Ben. Amy starts investing $200 every month when she is 25 years old. She does this consistently for 10 years, and then stops completely at age 35. She never adds another dime. In total, she invested $24,000. Her friend Ben decides to wait. He doesn't start investing until he's 35, the same age Amy stopped. Like Amy, he also invests $200 every month. But to catch up, he invests for 30 years straight, all the way until he's 65. In total, Ben invested $72,000. That's 3 times the amount of money Amy put in. Now here comes the shocking part. When they both turn 65, who do you think has more money? Despite investing 3 times as much, Ben still has less. Amy's account has grown to about $314,000. Ben's account is worth only about $291,000. This story perfectly illustrates the incredible power of starting early. Those first 10 years gave Amy's money a massive head start. By the time Ben began investing, Amy's money was already a formidable snowball rolling downhill, picking up momentum. Ben was starting with a tiny snowball at the top of the hill, 10 years behind. Even though he rolled his snowball for much longer and added way more snow, he could never quite catch up to the massive boulder Amy's had become. The time she gave her money was more valuable than the extra cash he put in. This is what we call opportunity cost. Every year you wait to start investing is a year of compound growth you can never get back. It's the most expensive financial mistake many young people make. But as we've seen, even small amounts can grow into fortunes if given enough time. Starting with just $50 or $100 a month in your 20s can be more powerful than starting with $500 a month in your 40s. Time is the greatest asset you have as an investor, more valuable than a high income or a large starting sum. Don't waste it. So far, we've been talking about how compound interest can be your best friend, helping you build wealth and achieve financial freedom. But it has a dark side. It can also be your worst enemy when it works against you in the form of debt. High-interest debt, especially from credit cards, uses the exact same compounding principle. but in reverse. Instead of your money growing, your debt grows. It's like rolling that snowball uphill in the mud. It just gets heavier and harder to move with every rotation, pulling you backward. This is how people get trapped in a cycle of debt that feels impossible to escape. Let's look at a common example: credit card debt. The average credit card interest rate today is over 20%. Imagine you have a $5,000 balance on a credit card with a 21% APR, annual percentage rate. If you only make the minimum payment each month, which is typically around 2% of the balance, you'd be paying about $100. In that first month, around $87 of your payment goes straight to interest, and only $13 goes toward paying down your actual debt. The next month, the bank calculates interest on your new, slightly lower balance, and the cycle continues. If you only ever paid the minimum on that $5,000 debt, it would take you over 25 years to pay it off. Even worse, you would end up paying more than $9,000 in interest alone. That's on top of the original $5,000 you borrowed. You would have paid the bank almost 3 times the amount you originally spent, all because of the destructive power of compound interest working against you. Every month, the interest gets added to your balance, and the next month, you're paying interest on that interest. It's a vicious cycle designed to keep you paying for as long as possible. This is why getting out of high-interest debt has to be your #1 financial priority. It's an emergency. You can't start building a skyscraper if your foundation is sinking in quicksand. Every dollar you put toward investing while carrying high-interest credit card debt is like taking 1 step forward and 2 steps back. The guaranteed 20% or more return you get by paying off your credit card is higher than any return you could realistically and safely expect from the stock market. Understanding the dark side of compounding is just as important as understanding its benefits. Your goal is to get it working for you, not against you. All right, we've covered a lot. You now understand the incredible power of compound interest, the immense value of time, and the dangerous trap of high-interest debt. So, what do you do with this information? It comes down to a simple 2-step plan that you can start today, right now. This isn't complicated financial wizardry. It's a practical roadmap to turn compound interest into your personal financial superpower. Step 1 is to make compounding work for you, and Step 2 is to stop it from working against you. That's it. Let's break it down. First, you need to put your money to work. Start investing as early as you can, even if it's a small amount. Don't wait until you have a significant sum of money, because time is your most valuable asset. Open a Roth IRA or contribute to your employer's 401k plan, especially if they offer a match. That's free money. Invest in low-cost, diversified index funds, like one that tracks the S&P 500. This approach lets you own a tiny piece of hundreds of the largest companies, and it automatically puts compounding to work for you. Automate your contributions so that every payday, a set amount goes directly into your investment account. This pay-yourself-first strategy ensures you are consistently building your snowball over time. Second, you must aggressively eliminate high-interest debt. The compound interest on credit cards and personal loans is a wealth-destroying monster. Make a list of all your debts, ordered from the highest interest rate to the lowest. This is called the avalanche method. Throw every extra dollar you can find at the debt with the highest interest rate while making minimum payments on the others. Once that top debt is paid off, take all the money you were paying toward it and attack the next one on the list. This creates a debt-killing snowball that gets bigger and more powerful over time, freeing up your cash flow and stopping the negative compounding in its tracks. Ultimately, mastering your finances isn't about one big win. It's about making small, smart choices consistently over a long period. By starting to invest early and systematically destroying your high-interest debt, you are placing yourself on the right side of the compound interest equation. You are setting up a system where your wealth grows automatically, powered by time and consistency. It won't happen overnight, but years from now, you will look back and be incredibly grateful that you took these simple steps. You have the knowledge. Now it's time to take action and build the future you deserve.